We already know that budget consolidations following surges in government debt hamper long-run growth through higher tax pressure, raises in inflation, and political uncertainty. Our new study now finds that public debt is bad for growth also because it hinders firms' investment and innovations. Movements in government debt impact firms' investment by affecting their cost of capital and, critically, by curbing innovation decisions. In the US, R&D-intensive firms face a high cost of equity financing compared to non-innovative firms. This spread is huge, about 7.5% per year. We analyzed more than 6,000 firms listed in the US through the 1975-2013 period. And we find that around 1/3 of the premium that innovative firms have to pay to their investors compared to regular companies depends on the exposure to fiscal variables. This means that without any fiscal uncertainty, the spread could decline to about 5% per year. When public debt is on the rise, spikes in interest rates and uncertainty on future fiscal pressure make future cash flow less predictable. This suggests caution to both investors and managers. When it comes to selecting which project to invest in, uncertainty forces managers to choose only the highly profitable and less risky ones, in response to increased investors' appetite for safer firms and assets. For example, say that in normal times with debt to output of 60%, a manager of an R&D intensive firm considers only projects with expected annual returns higher than 10%, say over a 5-year horizon. According to our computations, if debt to output increases from 60 to 100%, the same manager would consider only projects with a minimum expected return of about 10.3% per year. That is, she would require a 1.6% additional return over a 5-year horizon. Now, we can ask whether this is substantial. Over a 5-year horizon, once the lack of innovation starts to affect the national economy, the net result is a GDP growth decline of -4%, which is a very significant loss, especially in times of very slow growth. Our results mean that a policy of prudential austerity, that is, a commitment to reduce public debt during good economic times, paired with fiscal policies that prevent long-run tax uncertainty, could be the most effective. On the one hand, a systematic use of budget deficits undermines growth. On the other hand, what we find is that countries that have already accumulated a lot of debt may risk to experience future recessions with no leeway for future fiscal stimulus.